Are you satisfied with your understanding of sustainability? If you are not, imagine a journey together, a pluralistic one, with academia, innovators, startups, NGOs, all looking for solutions to the greatest challenge of our time. My name is Samuele Tini, and this is the Sustainability Journey. Welcome to another episode, and today we are going to discuss a topic which is particularly interesting, the financial risk. What are financial institutions doing in the light of the climate crisis? And we do it from a practitioner point of view, because of course we want to give practical advice from people that have been in the corporate world for many years. And we do the former corporate executive that's been more than a decade working in different banks, and now she's also joined in the teaching and trying to online and trying to spread the word and educate the people on what is climate risk, finance risk, and what does it mean also as well, disinvesting from fossil fuel. So I want to really welcome here at the podcast, Anna Lucas. Anna, it's a pleasure having you today.
Thank you very much. Thank you for having me. It's a pleasure to be here.
And Anna, you have a long experience working in the financial sector, and this is very important for us to understand the practicality. What does it mean going beyond the slogan and see how we can implement that, how a financial institution can be an actor of change. But before that, our usual question: who is Anna? What is your sustainability journey?
Yes, well, I have been a corporate banker for about 25 years, and that is how I really identify myself mostly professionally. I worked mostly taking care of corporate client relationships. I was responsible for the teams of relationship managers that took care of those corporate clients, and also the teams of corporate lenders, so those that were really negotiating lending transactions and putting them together to finance the big corporates. I also spent some time after that working as a senior manager in operational risk management, which enriched me a lot from the knowledge perspective and having a complete view about the bank, also from the side of risk and compliance. And all of that I did mostly for ING for many years in several locations in Eastern Europe. My sustainability journey really started about, say, some 10 or 11 years ago, when ING established a new sustainability team at the headquarters in Amsterdam. At that time, this was a novelty. Not many people were actively speaking about sustainability in the financial world back then. It was still before the Paris Agreement. So I really thought that this was a very visionary thing to do from the side of ING, or so I think it was. And as a manager then, on location, I had to implement new processes. We were asked, for example, from then on, with each new lending transaction above a certain amount, we had to provide information about how this particular transaction was going to help or have an impact in terms of the environment. So mostly at that time, we were speaking about these topics of environment. For example, we would be looking at a company and say, okay, do they have some problems with high pollution levels, for example? So is this investment, this new financing we are going to give them to help decrease the levels of pollution? Or are we going to finance a new equipment that will allow companies to recycle more materials, to reuse them, or to better waste manage their activity? So these were the main considerations at that time, and we had to start thinking about them already then, but this really resonated with me from the first moment. I really had the feeling that this is going to be a crucial thing for the future. I had the feeling already then that we were looking at the risks that were new types of risks that were coming to the world because of natural evolution of the world and the economy and the society. But this stayed always on my mind. And then, therefore, when I later decided to leave the bank and I started my activities as a banking instructor, I definitely said to myself that sustainability, ESG, and these matters around sustainable finance, that these are going to be the issues that I'm going to go to pass through in my courses. I really think I'm absolutely convinced that all bankers and anyone working in finance industry at the moment needs to be aware of all the risks and the environmental and social factors that surround us. And basically, this is what I've done lately. So I have a few courses that are dedicated to these topics, and I'm really glad that I have a wide audience around the world, because some of my students are really sitting in underdeveloped countries, and their access to this information and at certain high level of sophistication in terms of banking knowledge and financial knowledge related to climate is not really available, or the resources are limited. So I'm very glad that I have the possibility to do this at this moment.
Fantastic, Anna. And I'm sure also our listener want to understand a bit more why it's so important. They want to know from your wisdom and your long experience in the sector. And the first question is a bit of terminology. So, is now we need to understand, and you spoke about climate risk. They have now become financial risk. So can you explain a bit more this terminology, and maybe with some practical example, so that we can understand this topic?
Yes, this is really very important, and it is at the heart of the whole discussion, that we really need to understand why we speak so much about these environmental things and ESG and risks. This is all because of the risks we are exposed to, and this respects to corporations, to banks, to financial institutions, to anyone. The broader economy, frankly, is exposed to these risks. So climate risks are basically divided into two categories, and I will try to explain both of them and also give some examples of how they can affect them, particularly how they can affect banks and financial institutions. So the first category within climate risks are the physical risks. These are probably more intuitive to understand, because these come with the exceptional or catastrophic weather events. So the increased and intensified storms, hurricanes, floods, wildfires, also a little bit on a chronic level, the increased level of sea levels already. So every time there is an incident like this, huge financial losses happen. This, I guess, is quite easy to understand why. These hazards, they destroy entire communities many times. They destroy complete infrastructure. So obviously the property, the homes, the buildings, everything that is around in these communities gets destroyed, and therefore businesses are completely disrupted. And when you have a disruption in business, and you are a bank that is financing this business, or you are an insurance company that has insured this business or part of it, you are basically affected immediately, because the assets you relied on as a security for your loans and the cash flows you were expecting to have to repay your loans, for example, these are basically, they disappear. They cannot be there for a long time. So this is really a very big problem for financial institutions. The other category of risks that are not so intuitive, and it's a little bit more complicated to explain, but we'll go through it, are the transition risks. So what we have said is that in order to try to mitigate the hazards and the weather events, the extreme weather events and the climate problem, we have to transition to a greener economy, to a less intensive emission economy, right? So, but with this transition, we have also some transition risks. And these are all the market risks, technological risks, and policy risks that come with the fact that we are actually going through this transition. So let's have a look now about these transition risks. We start, for example, with the technological risks. So imagine that we are replacing the usage of fossil fuels by electricity or other type of renewable energy. This means that we have new projects, new investments in new technologies, in wind farms, in solar panels, in electrification, networks. So we are speaking about a huge amount of investments and changing the production patterns at corporates as opposed to the past. And every time we change something this big and this dramatic, obviously it comes with performance and economic viability challenges, because nothing goes linearly. Okay, so the pace at which we wish the investments would go will probably be disrupted. There will be delays, there will be things that will have to change technically multiple times. Demand in the end for this new renewable energy, in this example we gave, may not be there at the level we expected for some reason. So when banks and other financial institutions are involved in the financing of this complete transformation and new technologies, obviously they are carrying part of all these risks, that things go wrong, that the management of the companies, for example, even will not cope with the change. All kinds of financial problems will also be involved here. Okay, so in terms of the technology, a lot of problems within this transition. Then we have market risks. Market risks are basically defined by changing of consumer preferences. Okay, so consumer preferences are really shifting. Consumers are starting to demand a new type of products and services. They are willing to pay more for services and products that are less damaging to the environment, or that are produced with taking into account the human element. So, people are very sensitive at the moment to making sure that they buy products that are not done, for example, using child labor, or having very inhuman working conditions. So all these market preferences, this shift, what means is that some companies will obviously go out of business because they cannot adapt, and that they are not able to come up with different ways how to produce their products, and therefore the consumers will not buy them. But also, of course, many other companies will emerge as new businesses, those that in reality are able to make the transition, and buy new materials and do things differently. But again, a lot of problems for business, financial problems for businesses that won't be able to adapt, and by consequence also the banks involved with them will have a problem. And also banks will be looking at the companies when deciding where to lend money. We are looking at these companies, also asking ourselves today, are they going to have demand for their products? Are they going to be able to adapt to what the customer wants in terms of the environmental and social issues? So we are also very critical now, starting to be at banks regarding these issues. And finally, we have additional policies and the government intervention. There is a lot of new regulatory policies that come to regulate businesses, sometimes impose limitations. Mostly those businesses that are high polluting. We know that some oil fields and coal mines, for example, have already had to close down and close activities because it's not allowed anymore. So this type of policy and regulation is coming also to reduce the activities of some businesses, and obviously banks involved in those activities will have to take care about this. And the longer it gets to take to the Paris Agreement, the closer we are to get there, the more pressure there will be, and the more we will see this new policy and this new regulation being imposed. So a lot of additional costs here coming up, and obviously also the carbon taxes, okay, that come to put a price and to penalize those that are polluting. So these new costs for these businesses are really bringing a lot of financial pressure, not to speak about all the reputational issues and also environmental litigation that we are seeing, companies being sued because of damaging the environment and not transitioning in the way that they should. So sorry, a little bit of a long question here, but there is a lot of things really
Fantastic.
around this transition.
No, it's very good, and I really like how you have explained the different risks and how they play, and you kept going discussing about now the needs also of the risk. And the subsequent question is, of course, how the banks, the financial institution, are approaching now this revaluation of their portfolio in the light of the climate risk that we have just discussed. Which are the challenges they are facing in this process?
So banks obviously have also made their pledges, right, to reduce their so-called financed emissions, so the scope 3, so the ones that basically we are facilitating when we as banks finance the oil and gas and the steel and cement and transportation, so the high emitting sectors. But on the other side, banks also are doing a lot of profit financing these industries, right? So it's not easy to do this from one day to the other. Maybe we'll speak about this a little bit later in the conversation. But as regards portfolio revaluation, we at banks, when we do a portfolio revaluation, what it means is that we have to analyze our exposures and then decide if we are going to transform it, if we are going to keep it, if we are going to divest from it, so decrease this financing, or if we are going to reprice it, so if we are going to put a different price on it. And the first thing that we need to say about this exercise is that banks are not doing this exercise and not deciding about the reduction of their exposures to certain sectors or on a standalone basis. So this doesn't work in the way that one bank says, okay, so I'm going to reduce this financing to fossil fuels, for example, by 20%, and then another bank says it's 30%, and another. This is not how it works. So the way it works is that there is a benchmark scenario that set out the appropriate rate of carbon reduction in each particular industry. So this has been set at industry levels, and obviously when the banks are looking at their portfolios and trying to reduce their exposures to these sectors, they have to be aligned with this pathway. So there is an industry methodology behind all the decarbonization of each sector. But besides that, the way to do this in banks is then to go almost client by client, engaging with the clients and analyzing very specifically for each client what are their emissions at the moment, what are their targets, see if these targets are realistic, and then realize or make a decision whether we think really that this borrower is on the right path and whether we can finance his transition in a way that we will be providing other types of financing, or if in the end we will have to divest because we don't believe that this client is able to do a transition properly, and the risk is very high. So what we are doing here is that we have to make sure, for example, even if we decide to finance electric vehicles, for example, that is basically labeled as green financing, okay, even then we have to realize that financing electric vehicles comes with the issue of mining valuable minerals in developing countries. So are we sure that the conditions on which this mining is taking place are proper? So there are many issues here when we decide as banks to reevaluate the portfolios and shifting from one type of financing to the other. But basically the major risk is that we are looking at the credit profile of borrowers. So we have to make sure each client by client, particularly on those sectors that are the high polluting ones. So we have to make sure that we understand how our clients are exposed to the physical risks, first of all, where they are located, where their suppliers are located. And then we have to have a view that because of new policy or carbon prices in the future, whether the assets we have as collateral are properly valued. Most probably at this moment they will be, in my opinion, overvalued, because banks are not taking into account all risks that are there for the future. So we have to go and analyze the quality of these assets and what is the resilience of our borrower in the future for potential new policies, potential increase of carbon prices, and what the assets that this borrower is using for their activities. Is there a risk that they are going to be closed down, that they will have to shut it up? So we really have to go client by client, but at the same time, as I said in the beginning, having a view on and being aligned with the benchmark for the industry. Okay, so this is basically what we are doing.
Fantastic. And it's really interesting. And I have a substantive question. You know, when you say you have to go client by client, every day now we read in the press, corporate, especially big corporate, but also medium enterprise, they are now making pledges, net zero, to carbon neutral, 2030, 2050, 2062. So all these pledges and into also maybe emission reduction and other, how this is impacting the financial sector, especially in the context that you are already discussing?
Yeah. Yes, so this is very important question, because sometimes we have the feeling, I think the general public has the feeling that everybody is making pledges, but sometimes, they probably are not taken seriously, or they are just making pledges because they have to. And this is a very serious matter, because this is a lot to do with reputation, and we definitely don't want, as financial institutions and banks, to go and support companies that are making claims that are not true. So this is a very important question. But basically, what we are doing in terms with our borrowers and with our clients in banks is that we really need to scrutinize these pledges. It is a little bit of a part of the revaluation of portfolio that we spoke before. So we need to have a critical view on whether these pledges are realistic. We need to have bankers, by the way, at this moment, that are a little bit of sector experts. We need to have bankers that they really do understand the specific challenges and trends in particular industries, mostly regarding the decarbonization and climate risks, so that we can then evaluate whether what our clients are telling us and are telling the world outside, whether this is realistic. So this is part of the exercise we are doing when we reevaluate our portfolio. As I said, we need to take into account that sometimes the companies are doing these pledges, but then when we go into the detail, we realize that they are not taking, for example, into account potential increases in carbon pricing and or introduction of new carbon taxes. And I do believe that this is an area that is going to have a lot of developments, and this is something that must be discussed with the clients. The models are still being fine-tuned all over the place, so there is a lot of talk about climate scenarios that banks and corporates should go about and do their climate scenarios and test, if some things happen, how resilient they are, and so and so. But with all the geopolitical complications that we have now, with one war now, second war, this gets very, very difficult to do. But in any case, what we have to understand is that these pledges cannot be taken lightly, because greenwashing and reputational issues and are being more and more taken as criminal litigation risks. As I said, many companies are being sued already, and we definitely don't want that our clients, our borrowers, will be in a position where there is a huge reputational issue around. So companies that, on the other side, will lack a strategy in this respect and will ignore the problem of having to transition. So those that don't do any pledges and they don't care so much, in the end, we'll find out also that it will be harder in the future to find financing for them. So the more we approach the Paris agreement date, the more banks and financial institutions will demand from their borrowers and corporates that what are they doing in order to transition and to align their strategy with the emission reduction goals. So it will get more difficult for these companies to be financed. But at the same time, we also have some opportunities coming up. So new products are coming to the financial markets to finance this transition. So the whole area of green finance, of sustainability linked loans, sustainability finance. So a lot of products are available for those corporates that indeed do their pledges, but they stick to them, and then together with their banks, they cooperate and they find a way how to finance their activities going forward.
And thank you so much, Anna. And you pointed in your discussion 2 or 3 things that I want to go a bit in depth. You say that sometimes there's a contradiction. Sometimes, especially there are, on one side, you have discussed there is the pressure from regulators, the pressure from the consumers, there is the need of incorporating those risks and understanding, and really financing also the transition. On the other side, business as usual has been highly profitable for a company. And so how banks are aligning the commitments, especially to the Paris Agreement, the subsequent agreement, the various scope that are there, why also protecting what was now an interesting business and their business interest. And we will go maybe with a subsequent question to discuss the elephant in the room sometimes that is pointed out and then that is in the newspapers and especially now at the various scope and the public domain. So which are the strategy that they have to, the banks they employ to balance especially the conflicting goals? From one side, appeasing the shareholders, not disrupt, but on the other side, going towards this transition and enabling the transition.
Yes, so this is absolutely the biggest challenge I think we have on the financial sector, because on one side, we can really be as banks accelerators of change, right? Because we have the resources and can provide financing to the needed new technologies and projects that we need for the transition. So that's the good side, yeah. But on the other side, we are also the perpetuators of the status quo. Okay, as you said. So while we continue to finance and have large exposures to high emission intense sectors and activities, we are perpetuating the status quo, and it is absolutely acceptable that the public points this out. Now, there are two things here. First of all, let's look first at what banks are doing and how internally we can manage this, and then we go to the elephant in the room of why we cannot really go out of fossil fuels and just stop oil and all this, why it's not so easy. So strategies, a clear strategy that we are seeing in the financial sector, and I truly believe in this, and I think this is one of the main things, is that alongside with the commitments that banks have done to decarbonize their portfolios, they really have to change their set of KPIs, so key performance indicators for executive management, and they have to cascade it down to all levels of the bank. What does this mean? So maybe a parallel here, like maybe 30 years ago, when we would be in the banks and we would be evaluating the performance of corporate bankers, we would basically look at lending and we will say, okay, we want our lending portfolio to increase 15% year on year, okay? And then we would have all bankers going out and making new transactions and giving new loans, and many times they would not care so much about the risk that was onboarded, because their bonuses, their evaluation depended on the amount of loans. So the higher the amount of loans, the more they would be successful. And then later on, we realized in the banks that, oh, but this is not good, because now we have losses. But I mean, the bankers didn't care because their bonuses were already paid, right? I mean, they performed well. They brought the loans to the bank. So this led the industry to shift in the terms of the KPIs to include other evaluation indicators that were concerned about the quality of the loans. So it's not only to bring loans to the bank, but we also need to take care about their quality. So we take care about what is the cost of capital that we have with these loans. We don't want to have provisions in these loans. So a similar thing is happening here now. We have additional risks now that are coming to the banks and to the economy, and therefore we have to change the way we evaluate the bankers and the CEOs and the boards of the banks. We have to not only say we are going to decarbonize, but we have to make their remuneration linked to achieving these targets, and we have to be very transparent and very critical about what happens if the targets are not met. I don't think we are going to be able to do this in banks in a serious manner if we don't change the traditional KPIs we have now, just that is, profitability and quality of loans. That's all very fine. But now we need to introduce new KPIs. And this is already being done in certain banks. So this is very clear. And alongside with also the new product offering. So we also have to have targets for new product offering in terms of the sustainable finance products and the green finance products. And these two KPIs together are, in my opinion, the engine that will change the attitude inside banks, because we really need this. Now, the other thing is that what we were saying, that the portfolio reevaluation is a difficult exercise. There are a lot of things that we still are not capable to properly manage in banks, also because of data issues. Banks have been working for years with risk analysis that are based on patterns of loss given default for certain industries, but these are patterns that have been there for decades. Now with climate, we don't have this, because what is happening is that the recent events are so out of the norm that it's very difficult to use this data to have a real, very specific measuring of what the risk is. But this means that, we still have to try and do the best we can. The fact that it is difficult and the fact that we don't know exactly when the next climate event will happen doesn't mean that we do nothing. Okay, so the strategies in banks goes through the revising of the portfolio, looking at the pathways and the what the industry is doing, and then having a complete shift in change in governance and in the way we evaluate the people inside the organization to make sure that we stick to the pledges that we have done. Now, we can go to the
the
in the
elephant in the
room.
room.
Yes.
So the stop oil, why
Yes.
fossil fuel is so difficult. And
Yes. Well, it is very, I think it's a matter of that we tend to see these very bombastic things, and I do want to say here that all the activists behind these things, we have to understand them and support them in a way, because they are doing a great way in terms of raising awareness for a very big problem that we have in the economy. Okay, so it might seem sometimes that it's bombastic and that they are doing crazy things, but we have to praise them. Now, the thing is that there are other factors and facts to take into account. For example, there is currently no real alternative to fossil fuel energy in the world. There is simply none. So, okay, some industries will never be able to function without fossil fuels. We know this, and this is going to be like this. As far as I know, the demand from fossil fuels, particularly for oil, keeps increasing. While the demand keeps increasing, the corporations need to work to meet the demand. Okay, so it's not going away anytime soon. Even if you look at the geopolitics and the wars that we are having, not many people speak about this, but if you look at military is probably going to be the last sector that will ever is going to move from fossil fuels. I can't imagine how we are going to electrify, I don't know, tanks and all the other stuff. So, for example, okay? So also very important topic that I think doesn't have sufficient attention. It's so important is that fossil fuel corporations and the all related value chains around them, they employ millions of people all over the world. So what would happen if suddenly these would all shut down and these people become redundant? I mean, there is no alternative at this moment for these people. Nobody is planning what are we going to do with this social issue of millions of people that are employed in this industry, right? So huge thing here. We don't have alternatives for this. We want it to happen, but we are not preparing sufficiently for this. Also, some countries are clearly dependent on fossil fuels for their own development. In order to receive funding from multilateral institutions to build infrastructure and all that, they need to demonstrate and they need to make use of the resource of fossil fuels they have. So it's a very complex subject, and it cannot be made in a general way, because also each country, each region has a completely different relation to fossil fuel, and fossil fuels have a different role in the way that economies work. So I think that we need far more support and clear policies from the side of governments than we have at the moment for this issue. To expect and demand that the financial sector is the sole or the main actor, leading this gigantic economic shift, it's just unrealistic, okay? We can also not just generally blame bankers, ordinary employees in the banks. I've seen some things in some instances in the press. I mean, these are ordinary people that are working in the banks to feed their families. What do we want from them? That they risk losing their jobs by just suddenly being against what their employer targets are? I mean, we have to think better. We have to have a very concerted action for this goal. Yeah, it's a complex goal that has to be put in place by corporates, governments, supranational institutions, and obviously the financial sector. But we cannot expect, it's just unrealistic that this goes away immediately and right now and stop. We have an obligation also towards our customers. We as banks, we have these relationships with these corporations, and like it or not, we cannot just move away without having some alternatives and without having a plan how to do this. So yeah, it is much more complicated than the press made it seem, I guess, when you look at the reality.
No, that is, it's really understandable. And of course, it is a path that need to be crafted in a way that is being a soft landing. Of course, we all know the risk of fossil fuel, the problem, but also you have shed light on the intricacy of just like, we cannot just with a magic wand and say from tomorrow zero, because of course, we have a lot of geopolitical problem, also different country and levels, and also the rate of development of some country, which they, of course, they are still very carbon and fossil fuel intensive production and industry. So it's a complex issue that really needs maybe investment from the policy side, support for a just transition, and maybe just and fast transition, but also that take in consideration all what you have of course discussed.
Absolutely. Maybe, sorry,
yes.
Maybe just a final thing still on this topic. The problem also is that these industries generate so much profit, so much money, that it becomes very political, and the matter of lobby and politics sometimes overcome reason and overcome even maybe the will that banks and the financial sector would have. Okay, so let's not forget also this, and that's why I say that the role of governments, and also you mentioned this, is absolutely, in my opinion, still lacking in this respect.
Definitely, because of course the pressure for the status quo on one side is still high, because of our returns are, especially in these times, we have seen skyrocketing profits. So it needs to be balanced. Of course, you need to balance everything and then have a clear path, which we know that the consumption will peak, in the next maybe 5 years or so, and then we start decreasing, but the decreasing still with high level. And on that, I want to ask you, Anna, of course, banks more and more, of course, and financial institutions now will need to navigate this moment because, of course, the pressure for regulation, especially on this hot topic, but even other, and also the reputational risk. We have seen, the dirty bank, oil bank, and maybe armed bank, and discussions and especially for the climate and the reputational risk from the climate related issues are going to grow, are going to become big, are going to affect also some business. So which are measures the financial institution are taking to mitigate this risk?
Yes, so this has a lot to do with governance and the way that financial institutions are organized and the way they take sustainability seriously. There is already a lot of guidance out there about how to report and disclose and tell to the regulators and the public what are the risks and what are the banks doing and the financial institutions doing in this respect. So it is not for lack of guidance. Of course, it has taken a long time because a lot of standards are out there and sometimes they are not comparable. So there's a lot of discussions here and there. But there is a lot of guidance already. So it is just a matter of making sure that banks have in place a governance strategy that really goes across the whole organization. So, and also it is about transparency. Okay, so it is very important that financial institutions are very transparent and disclose what they are doing, but also that they are accountable. So if they do not meet a certain target, it's important that they admit this, they explain why, and that is clearly stated, because this is an issue. It is a difficult matter, it is a sophisticated matter. We are not going to be there where we want to be quickly and easy, but you have to take this seriously. And the most important thing is that you need to have inside the financial institutions dedicated people with knowledge about sustainability, carbon accounting, environmental economics. You need these new people to get into banks, this new talent. You cannot just go and add to the responsibilities of existing employees some things that go to deal with this issue. This you need really to allocate resources for this. And as I said, it goes also from the KPIs. So a point of view, we have to evaluate people already, starting with the executive management on what is happening. The regulators are going to be more and more demanding at all levels. So I do expect that also in terms of the pricing of real risk, so loan pricing models, and so will be at a certain moment changed and upgraded because of this, because we need to make sure that banks and the financial sector has sufficient capital buffer and liquidity buffers for potential unexpected risks for this, because as we said already before, some assets are clearly over evaluated and some risks are not taken into account at the moment still. So there is a lot to be done, but it is a matter of governance and it is a matter of attitude from the side of the financial sector and of mindset. It really has to be a priority at the board level to start with.
And now, since you just maybe given me the note for the next question. So now we have recognized, we know the problem, we know the many issues that are there, and also the difficulty to be the disentangle from the status quo, but the need also to transition because of the risk, the government, and the reputational risk. So given your experience, how financial institutions can integrate sustainability in their operation?
Well, yes, we spoke about it a little bit already before. So it's a matter of this governance and it's a matter of the attitude. and everything. But I think that what really needs to be done is that we have to understand that most of all, this is a risk exercise. Okay, we really need to understand fully the risks that are at stake, and we need to scrutinize the exposures we have in the financial sector. We mostly hear about what big banks are doing, but there are still dozens of banks out there that do not have the concerns about sustainability on the top of their agenda, and the risks there are really mounting. So it is a job also for the regulators to, to tie in, and they are trying to do it, but regulation, as I say, always comes late. So I guess we will probably have to see some failures in order for then things moving quicker, unfortunately. But the first scrutiny of clients for this respect needs to start at onboarding. Already when we start to deal with a new client, we need to understand what are the climate risks and what the borrower is doing. This is all about understanding very well, credit risk, and now including the climate elements into the analysis of risk. So we really need to scrutinize and then understand this. And also very important, we need to start changing our loan agreement. So we need to have clauses in the documentations when we lend money to clients that refer specifically to their decarbonization targets, and make sure that we have it there, and make sure that we periodically review it and track it with the client. All right, so this is again another way how to force the corporations to think about it and to be serious about the pledges they do, and because they will not be able to get finance without it, and the banks will be checking on this. And it might seem that for some people it says, oh, the banks are controlling everything that I do. Yes, but I mean, we are lending money to these companies. We are putting the money of our depositors and of our shareholders at risk. We need to be responsible about the way we give money to whom we give money to. This is all about being responsible in the financial sector. So lending decisions have to change. Lending, monitoring has to change. We have to have new processes inside the banks and the credit institutions to make sure that across the bank and also with the clients, we have a way out to monitor all this. Because otherwise, also our targets for the decarbonization as banks will not work. This is then just, it's a circus. It's not a bank in the end. If you don't do
Fantastic.
things, probably.
And very clear, Anna. And I just want to say, you say we need to change this, we need to change that. How do you see the future of sustainable financing going, especially in the next 5 to 10 years? What do you see, especially in the light of this global climate change mitigation effort and others' effort in that space? How do you see this trend?
This is probably the good momentum of all this, because I keep speaking about risk and risk and risk, but indeed it is what it is about. But this is the good momentum. Okay, so the climate risk, and so this is also bringing to the banks and the financial sectors and to the corporates a lot of opportunities, new opportunities, and clearly sustainable finance is one of those momentums. This is going to continue booming, because as we transition more and more, so more transition projects will be there that needs to finance, so the renewable energy, but also in carbon capture, hydrogen, green fuels, also in farming, a lot of climate tech, weather prevention technology. So all of this is going to have a huge boom. There are a lot of predictions of trillions and trillions of dollars that are going to be needed for this transition by 2030, and even more than by 2050. So I really see a lot of opportunities here, and a lot of interesting transactions for banks and for the corporate, the financial sector, and also a possibility for banks and credit institutions to deepen their relationship with their clients, because by speaking about these things together, by having the goal together of both the bank and the corporate to decrease their carbon, how carbon intensive they are. This is a common goal. So it will be a lot of a possibility for bankers to get closer to clients and to do things together for a common purpose. So from this perspective, I am also very excited about sustainable finance and all this problematic, because it goes to my corporate banking background, the managing of the relationships and know your client, but now with really a very common goal that can allow for a partnership in a way that we help each other, achieving some good goal that it's basically a win-win, So I do think that this is going to have a huge development, and also more and more the qualification for the green claims and green finance is improving. So we have less and less risk that loans are labeled as green or as sustainable where they are not. So things are getting, more transparent and more followed up, also from this perspective of the regulatory and claims. So I'm very positive about this. This is one of the light moments of this conversation, I guess.
Fantastic. And it's really important. I really enjoyed the conversation and the discussion. And you really have shown from the beginning the discussion about the subjects, defining the risks, then going towards the portfolio, the discussion about also the hot topic on how, especially some sectors are very difficult, and also giving us a bit of the future and the opportunity, not only the challenges that there lies ahead. And as last question, just for our audience, what piece of advice would you offer to banks, financial institutions, but even people, they want to transition towards more sustainable practices, but of course, maintaining also the important the business viability. So how they can have this win-win model?
Yes, well, I think the important thing to understand is that the business viability in the long run will only be there if indeed you have a resilient business and you are sustainable. If indeed you can demonstrate that you are aware of the risks and you are prepared for them. And this again, that's why we need to do this reality check on our portfolios, because we need to be resilient, we need to prepare for them. There is no going back. These are risks that are here, they have evolved, they appeared, well, they were there also in the past, but we did not realize they were so big and so relevant until recent years. So we cannot run away from this. This is not something we can run away from. These are evolutionary demands, so to speak, evolutionary risks. So the only way is really to start this journey the sooner as possible, because the harder, the longer it will take, the more we delay, the harder it will be, and the more expensive it will become. New policy, new carbon taxes, everything is coming to make all this very, very expensive. So I would just advise that every board just takes this issue really by the reins. You have to set targets, look at industry pathways, realize the portfolio, measure your targets through your KPIs, allocate resources to the whole agenda. Don't cut costs on this. This is the area to allocate resources to, and then be responsible and transparent with new transactions and with the new opportunities and the new financing. So this is basically all that is to it. Viability is only going to be there if the business is strong and if the business is sustainable. That's the final point.
Fantastic, Anna, and thank you so much for this wonderful and such insightful episode. I'm sure people will appreciate, and it has been a pleasure and honor hosting you. Thank you so much, Anna.
Thank you very much, Samuel, for having me. It was a great talk. Thank you.
Are you satisfied after this wonderful episode? Let's continue together our sustainability journey.